So here we're going to talk about how to trade pin bar reversals successfully, profitably, and effortlessly as well. We will discuss the selection, timing, management, and we'll give you plenty of practicals so that you can be rest assured that you understand. So first of all, what we want to do as end-of-day traders is look at the daily chart and ask ourselves, do we have a bullish pin bar reversal? Like so, it could be a green bar, it could be a red bar, it might not even have a color at all. But the way we quantify it is, do we have the open and close in the top half of the bar, or ideally the top third, and do we have a tail? Similarly, if we're looking to go short, we want to look for a bearish pin bar reversal, like so, with the open and close in the bottom half and bottom third of the bar, with a tail also. So very similar, just the other way round. So we've got our price action set up with bearish and bullish pin bar reversals. So now we want to go and see, so what else do we have in support of this trade, price action wise? Whilst on the daily we might have, for example, a bullish pin bar reversal, do we have the shorter term bars and sellers essentially agreeing with us? We'll find out. The way we can do that is looking at the hourly and seeing whether we have a bullish reversal pattern pointing to the direction we are looking to go. Say, for example, if we're looking to go long off the back of a bullish pin bar reversal, we want to look at the hourly and see, okay, do we have a double bottom or an inverse head and shoulders? Conversely, if we're looking to go short, we'd want to look at the hourly and see, with our bearish pin bar, we'd want to see a double top or a head and shoulders formation, as these are bearish reversal patterns. And if we've got, say for example, a pin bar reversal on the daily and a bearish reversal pattern on the hourly, this is known as time frame confirmation. So now we've got the price action dealt with, we want to see what technical reasons we have in support of our trade. Depending on the state of the market, whether you're trading a trend-based continuation or a reversal of a soft or a hard level, these have different requirements. For a trend, we're a little bit more demanding in what we want. Certainly we want the pin bar reversal, as this is the name of the strategy, it makes a lot of sense. We want the reversal on the smaller time frame, and we want at least two technical reasons from the list, which we're going to go through in a minute over the page. For a hard level, i.e. a level of support or resistance that hasn't been broken in over a year, then sure enough we want the pin bar reversal and the reversal on the smaller time frame. But it's not essential to have the technical confirmation, however, a bonus. And for a soft level, i.e. a level which has been broken in the past year but also respected, it is essential to have a pin bar reversal, obviously, and also a reversal on a smaller time frame. But it's not essential to have technical reasons. However, it is a bonus. You might want to add that filter yourself and say, well, providing I've got like a reversal on a smaller time frame and a pin bar, I want at least two reasons, like a trend. However, from our experience, we found that just a pin bar as well as a reversal on a smaller time frame is sufficient. But when we talk about technical levels, let's show you what we mean here. This could be a trend line, i.e. with cyclicity, a rejection on the weekly or monthly pivot, R2 or S2. Are we rejecting a moving average, a big psychological number? Or are we rejecting a hard level? It could be a soft level. We could have divergence on the daily, and we could have it on the hourly as well. Or do we have a Fibonacci rejection, 50, 0.618, or 786 at those Fibonacci retracement levels? If we have any of these, then it's a bonus, certainly if you're trading off a hard and soft level. If we're trading a continuation from the trend, then we'd want at least two of these factors agreeing with us here. Okay, and I would recommend that you print this out and paste it to your wall or cement it to your desk, because these are important. These are our technical reasons. We don't really look at anything else in support of our trade. These are all the technical reasons you need to agree with your trade. But of course, you don't need all of them to agree, just a few, minimum 2 if you're trading with the trend. Certainly if it's a reversal off a horizontal level, then they're a bonus. However, the more that agree with your trade, the better your trade essentially is. We've talked about the selection, what kind of bars we want to look out for, and what kind of technical confirmations we want, but how about the actual management of the trade? Well, it's very simple. All you need to do is look at the high and the low of the bar. Say, for example, take this bullish pin bar here. We want to place our entry just above the high of the bar if we're looking to go long. We look for the price of the high of the bar. We find out what the spread is with our broker, and we add the spread to the high of the bar plus a pip. So, for example, if the spread's 5 pips, we add 1 pip to that. So we've got our entry 6 pips above the high of the bar. And it's the same with the stop loss as well. We look for the low of the bar, and whatever that price is, we subtract the spread, and we subtract an extra pip as well. It's just to prevent us from being triggered into the trade prematurely. If that happens by a whisker, and it goes the other way, it's not good. We only want to be in the trade if our activated bar, i.e. the pin bar reversal, has broken out well and truly in the direction we want it to go, i.e. long if we're trading a bullish pin bar reversal, or short if we're trading a bearish pin bar reversal. And it's the same principle with bearish pin bar reversals here. If we're looking to go short off the back of it, we place our order at the low of the bearish pin bar reversal, minus spread, minus a pip. Conversely, our stop loss goes above the high of the bearish pin bar, plus spread, plus a pip. In terms of when to place our trade, as we're trading end of day, we really do mean quite literally at the end of the day. So anytime after 10 p.m. GMT, Greenwich Mean Time, or first thing the next morning GMT, like 5 to 8 a.m. or preferably 5 to 7 a.m. GMT is good. Obviously at night's better, but sometimes if you're out and about having a good time and the consumption of alcohol is involved, it's probably not a good idea you place your trade last thing at night before you go to bed. Just wait till the next morning, because the markets don't really move overnight unless they're a yen pair. In terms of setting targets for your trades, we always want to at least have an idea as to where we want to get out the trade prior to placing our trade and setting our target, or our limit level, which is essentially the price where we tell our broker to get us out of the trade automatically if price action hits it. Obviously, we want to select our target within the realms of possibility or probability, but we are presented with a trade-off, and I just want to ask you, what would you rather have? Would you rather have a higher probability, lower reward target profile, or would you rather have a lower probability, higher reward profile? It depends what kind of a person you are. Certainly the former is for a kind of person who'd rather have a higher frequency of wins, but in trade of that, smaller wins, or the second kind of person who would rather have huge winners but have to sacrifice the advantage of having more winners than losers. They will invariably have a higher frequency of losing trades, although their winning trades will be far higher in percentage gain. For example, you're a high probability, low reward kind of person. You probably want to trade to the next technical level of horizontal support or resistance, or the previous swing high. Or if you are a low probability, high reward kind of person, you probably want to go for just in advance of a price extremity. Take it to the top of the range, the bottom of the range if you're going short, or a higher high if we're trading long with the trend, or a lower low if we're trading short with the trend. However, with our trade management, which we'll talk about you later when we're in the trade, you'll be locking in profit along the way as well, so you don't need to worry so much. It's very likely your trade will be stopped out in advance of you hitting target, but at a profit thanks to our trade management. Because on one hand, we want to lock in profit, but on the other hand, we want to give our trade enough room to breathe. Okay, so to consider that we've placed the orders, Now what we do is we walk away from the screen. For 24 hours, we don't even want to look at it. 24 hours later, look at the broker platform. If we've been triggered into the trade, great. What we do then is we simply manage it accordingly. If we haven't been triggered into the trade, then we delete the order. And the reason why we delete the order is pure and simple. If our trade has not been triggered after we've placed our order, then that's the market's way of telling us that there's no decisive momentum in the direction we are looking for the trade to go. So it makes sense to not basically be in the flow or in the market if there's no decisive momentum. Because of course, as traders, what we want is for price action to go our way and as quickly as possible. And in a market where that's not happening, we don't want to part of that at all. But consider you are in the trade. Our next job is to manage it so that we can lock in profit. So here we go. If we're going long, for example, off a bullish pin bar reversal, what we want to do is move our stop loss and trail it for every second buyer bar, like so. We've got buyer bar 1, buyer bar 2. We trail our stop loss to the low of the second buyer bar minus spread minus 1 pip. And we do this for every 2 buyer bars. So we've got buyer bar 1 again, buyer bar 2, and now we want to trail our stop loss minus whatever the spread is, minus 1 pip. Buyer bar 1, buyer bar 2, we want to trail again, move our stop loss to the low of the second buyer bar, minus spread, minus a pip. And this is a really nice objective way of managing your trade. And it's important to be as objective as possible in the management of any strategy, because frankly, the market is a chaotic, random mass where anything can happen at any time. And you will arrive at a point where you're trailing it, you're lucky in profit along the way, but then you're stopped out, but at least you've got something from the trade, a nice percentage gain, as well as a well-executed and managed trade. Conversely, if you're going short, it's exactly the same principle. You trail your stop loss for every 2 seller bars. So for example, we've just been triggered into the trade here. We've got seller bar 1, seller bar 2, and then we trail our stop loss to the high of the second seller bar, plus spread, plus a pip, and we carry on doing this. We've got seller bar 1, we've got a buyer bar. There we go. We've got seller bar 2 here. Then we trail our stop loss above the high of the second seller bar, plus spread, plus a pip. So you can see that trailing for every 2 bars the trade is going in your direction is a nice objective way of doing it. It's low maintenance. It means that you don't have to be in front of the screen constantly tending to your trade. There's no fun in doing that, quite frankly. We want to have our money working hard for us, and certainly through trading pin bars, this is the way where we can ensure a very good return for the amount of time spent in front of the screen, unlike intraday traders. So here we go. We've got our first example here. We've got the pound Norwegian krona here. We've got a test bar, or a bearish pin bar reversal, as many of you would refer to it as. But what's so great about this? Let's take a closer look. So now we'll just see if this bearish pin bar reversal is actually bouncing against any key levels of support or resistance. Here we go. We've got a level right here. As you can see over the longer term, it's a soft level. You can see it's rejected, tested and broken quite a few times. So we're in a vague downward trend here. Let's see if we've got anything else. Let's take the Fibonacci retracement from the start of the move. And it's rejecting the 50% Fibonacci level. Great. That's 1, 2 ticks in the boxes now. Take it from this swing as well now. Pretty much the same thing. Take it from this swing high. Not quite a rejection of the 618 Fibonacci retracement. Let's see if we've got a reversal on a smaller time frame, on the hourly. Fantastic. We've got a head and shoulders formation respecting this soft level of resistance, which is time frame correlation, creeping in our favor here. So at the moment, it does meet all the rules for us. So we will go and place that trade. In terms of targets, it makes a lot of sense to take it to the bottom or the next level of support down for a decent reward to risk here. So here's how the trade went. The low of the bar minus spread minus a pip. We had our stop loss above the high of the bar plus spread plus a pip. And we trailed it for every second seller bar. So we trailed it here for seller bar number 2. Then we trailed it here for seller bar 1, seller bar 2. Fantastic. We trailed it for the other second seller bar here until we were stopped out the next day. So here we go. That gave us a gain of, well, just shy of 1%, 0.75%. Hardly anything to get wildly excited about. However, you don't know unless you try, and the reward to risk profile was satisfactory to us at the time of placing the trade of 2.5 for 1. So that doesn't matter. The trade doesn't always have to go our way. Sometimes they don't. That's the beautiful thing about reward to risk. Let's look at another example now. We'll look at pound New Zealand. And we've got a bearish pin bar reversal again off this horizontal level. This looks good. So taking a closer look, we can see that we've got a hard level of resistance up here, a level which hasn't broken in well over a year of the time this trade manifested itself. This level's been held for a year and a half actually. So it looks worthy of having a hard level. You can see that it's also been a soft level in the past as well, and it also corresponds with a decent psychological round number, 2.100. Now we've established it's a bearish pin bar reversal off a hard level, and it's also a psychological number. However, what about this all-important reversal on a smaller time frame? Let's take a look at the hourly and see what it says. Yes, we do have a triple top, like a double top, but 3 arches instead. It's making higher highs, which is fine. We can see on the RSI it's diverging massively, which is a bonus. So we've got a reversal on the hourly time frame. We will only be in the trade if there's a conviction break of the low, like we've already had, like so. And anything else in support of this trade will be a bonus. So let's have a look. What else could be in support of this trade? We've got actually RSI on the daily as well. You can see here that we've got a lower high on the RSI 14, whilst on the price action we've made a higher high. And whenever we have lower highs on the RSI met with higher highs on the price action itself is a sign of divergence. So that's an extra tick in the box. As we can see here, we're essentially at the top of a very well established range, and our target will be 4/5 the way down this range in order to get a very decent reward from it, and we'll manage it along the way. Let's see how we did. So here we entered just below the low of this bearish pin bar reversal. We took the low of the bar minus the spread minus a pip, and we had our stop loss above the high of the bar plus spread plus a pip, and we trailed for every second seller bar we had along the way, as you can see here. And it went a decent long way, and these are the kind of runs we're really interested in here, where we don't really have to do anything apart from trail for every 2 days. We've got an objective way of managing the trade, and we can just constantly lock in profit, safe in the knowledge that our money is working for us. And the reward to risk was 9.3 to 1, which is a very handsome reward to risk. And our actual gain of this was 6.6, risking only 1% for this trade. Moving on to pound Swiss now, we have a bearish pin bar reversal and great cyclicity on side here. Let's take a closer look though. All might not be what it seems. As this is a trend-based trade and we're trading the continuation, we need a lot more in support of the trade in terms of technical reasons than if it was just a range-based reversal trade. So here we can see that it's bouncing off a trend line. If we draw our trend line here, we can see that we have, well, 1, 2, 3, 4 touches. Do we have a horizontal level though? That is the burning question. Let's see if we have one. Put it on here. We do. You can see it's a soft level. That's fine. It's been tested and rejected a few times. We're also rejecting a big round number, and we're with the ebb and flow of this downward moving trend, which is making lower highs and lower lows. But do we have that all-important reversal on the smaller time frame? Let's take a look at the hourly. Yes, we do. We've got a rather deformed-looking head and shoulders to support our short position. So we've got a few reasons so far in support of the trade, which has met our minimum required reasons required to get into the trade. We've got the rejection of a horizontal level, round psychological number, a trendline bounce, reversal on the smaller time frame. But what else do we have? Let's see if we've got any added bonuses to this one. Let's see what the Fibonacci retracement is saying. We'll take that from the most recent swing high to the most recent swing low. Great, it's rejecting the 0.618. Let's see what it's looking like from the start of the move. Yeah, rejecting the 382, shallow retracement. So we have here a Fibonacci cluster. Fantastic. And for this reason, we can say quite solidly that the trade looks like a very good potential for the reasons we've established, not least to mention the fact that it's a bearish pin bar reversal as well. But how did we do? Let's take a look. Okay, so our target was the most recent swing low here, which makes abundant sense if we're trading a trend continuation. So we entered just below the low of this pin bar reversal, minus spread, minus a pip, and our stop loss was the high of this pin bar plus spread plus a pip. And we trailed for every two seller bars, just above the high of every second seller bar plus spread plus a pip, to be our objective way of managing the trade. And we were stopped out, pretty much at break even. So despite the trade looking very nice and having numerous reasons for it, it doesn't necessarily guarantee that it's going to hit target. Sometimes we do get trades at break even. However, had we not managed it, we would have lost despite making an initial gain. And it's one thing to make money whilst trading, it's another thing to preserve your capital. And with trade management, like we're doing, we are not only locking in profit, but we're preserving capital at the same time. Let's look at the FTSE long here. We've got a bullish pin bar reversal off the back of a trend line from the looks of it, but let's take a closer look and see what other reasons are in support of this trade continuation where we're trading with the trend. Well, as I just mentioned, we've got the third trend line bounce here, but is that important enough on its own? No, we want several confirmations that this is a decent trade, or as many as possible, actually. So is it rejecting a horizontal level as well? Let's see. Yes, we've got a horizontal level here, as if we look on the lower time frames, as we look across a greater period of time, we can see that this horizontal level has both been broken and respected, so we can quantify it as a soft level. But what else is in support of this? Let's have a look at the Fibonacci retracement tool, take it from the most recent swing low to the swing high, respecting the 0.618, which is a bona fide Fibonacci retracement number. And let's see if we take it from the very start of the move to the top, it's also respecting 0.382 Fibonacci retracement level as well. So we have a Fibonacci cluster here as well. But how about the smaller time frames? Let's see if we've got a bullish reversal with a higher low or an inverse head and shoulder in our favor here. We certainly do. Even though it's very gradual and very faint, we can see it's got a higher low, and we've got that classic W-shaped formation on the hourly to prove to us that the momentum is starting to shift after a period of retracement according to the shorter term buyers and sellers. This is, of course, mirrored by the fact that we've got a low test or a bullish pin bar reversal on the daily time frame. So we've got time frame correlation here. But let's see how we did, because we might have enough reasons to go long, but it doesn't necessarily guarantee a winning trade or the trade hitting target. We need to manage the trade and hope for the best, but fear for the worst. So this is how we did. We had our target at the previous swing high or just below for a high probability lower reward outcome. We had our entry just above the high of this bullish pin bar reversal, with our stop just below the low of this bullish pin bar reversal, minus spread, minus a pip. And we trailed our stop loss for every two buyer bars. minus spread minus a pip it was trailed to on the second buyer bar, and we got stopped out on day 4. However, we made a pretty handsome gain on this one. We made 2% overall. Even though our reward to risk was a 4 to 1, we managed to lock in 2% for our trade management, risking only 1%. And let's take a look at our final example here, which is pound CAD for a long. And we can see that we're in a range-bound market here, which is not necessarily a bad thing. Let's take a closer look. So we can see that by squashing this data in, we're able to see that this is part of a much longer range, or much longer term range. So we've got our horizontal level here, which is rejected. It hasn't breached this level for over a year. And we've got levels of support, soft levels as well, as we can see. Just drawing them in. So best case scenario, we could trade this long and it can go all the way to the top of the range, all the way up to this point here. However, we want to go for a higher probability and sacrifice a bit of reward for that higher probability and maybe take it to this level instead. Let's see if we've got anything else in support of this trade. Like the rules dictate, for hard levels of support or resistance, we're trading pin bars off them. We don't need so many technical reasons. However, it's very important that we get a reversal, in this case, a double bottom or an inverse head and shoulders in favor of the direction we want to go, i.e. long. And looking at the hourly, we have that right there. We've got an inverse head and shoulders, which is fantastic. So to conclude, we've got a bullish pin bar reversal, or a low test, as some of you might refer to it as, supported by an inverse head and shoulders on the hourly time frame. But how did we do? Let's take a look. So we had our entry just above the high of this pin bar reversal, plus spread, plus a pip, and our stop loss was just below the low of the bullish pin bar, minus spread, minus a pip, and we trailed our stop loss on the second buyer bar, with our stop loss at the second buyer bar's low, minus spread, minus a pip, and we did this for every 2 buyer bars, and we managed to take it to a good distance of the way up, and it actually hit our target. The gain was 6.8%, risking 1%, hit our target. If we risked 2%, then of course that would have been a good 13% plus. But it's up to you how much you want to risk. We generally recommend that until you're consistent, i.e. had at least 3 months of profitability, you don't risk any more than 1% of your account. So this is pin bar reversals. It's the bread and butter strategy behind our percentage gains every month.